Imagine you are an investor who owns a bond, and you are worried that the company might default. So, you decide to buy protection, just like buying insurance. This protection comes in the form of a credit default swap, or CDs. In this contract, you become the protection buyer, and you agree to pay a regular premium, called the CD spread, to another party known as the protection seller. In return, the protection seller promises that if the company defaults, they will compensate you for your loss. Now, these premium payments are not made at the beginning of each period like traditional insurance. Instead, they are paid at the end of the period, which is called paying in arrears. And here is something very important. If default happens in between payment dates, you still have to pay the premium for the time that has passed since the last payment. This is called accrued premium. For example, if payments are annual and default happens after 3 months, you will still pay 3 months' worth of premium. A CD's contract can be written on a single company, a country, or even a group of companies through an index. These contracts are standardized, usually with maturities like 1, 3, 5, 7, or 10 years, and payments are often made quarterly. Now, interestingly, the CD spread is closely related to bond yields. Ideally, the CD spread should match the extra yield investors earn on a risky bond over a risk-free bond. The difference between these two is called the CD's bond basis, and in efficient markets, this value should be close to zero. Next comes a key concept called the recovery rate. This is the percentage of the bond's value that can be recovered after default. For example, if a bond with face value 100 trades at 53 after default, the recovery rate is 53%. In CD's contracts, the protection buyer delivers the cheapest eligible bond, known as the cheapest to deliver bond, and the recovery rate is based on its market price. Now let's understand how CD's pricing works. The CD spread depends on 4 main factors: the probability of default, the risk-free interest rate, the hazard rate, and the recovery rate. The hazard rate represents the intensity of default, and from this, we calculate the probability that the company survives up to a certain time. The formula for survival probability is PS_T equals E caret, lambda T, where lambda is the hazard rate. The probability of default in a given year is simply the drop in survival probability from one year to the next. For example, if the hazard rate is 3%, the survival probability after 1 year is E caret, minus 0.03 times 1, which is about 0.97045. After 2 years, it becomes 0.94176, and after 3 years, 0.91393. From this, we can calculate default probabilities for each year by taking differences. These probabilities are crucial because they help us estimate expected payments and expected losses. Now, as the protection buyer, you only pay premiums if no default occurs. So, the expected premium payment in any year is the probability of survival multiplied by the notional amount and the CD spread. But since these payments happen in the future, we discount them using the risk-free rate. The present value of expected payments is calculated using the formula PV equals discount factor times expected payment, where the discount factor is E caret, R times T. There is one more adjustment to consider. If default happens in the middle of the year, you still owe a partial premium for that year. This is called the accrued premium, and it is usually approximated as half of the annual payment. This amount is only paid if default actually occurs. On the other side, the protection seller is expected to make a payment if default occurs. The expected payoff to the protection buyer is calculated as 1 recovery rate multiplied by the probability of default and the notional amount. This represents the expected loss due to default. Now comes the most important idea in CD's pricing. The fair CD spread is determined such that the present value of expected premium payments is equal to the present value of the expected payoff. In simple terms, the cost of insurance must equal the expected loss. Mathematically, we write this as PV of payments equals PV of payoff. Solving this gives us the CD spread, which might come out to something like 1.99% or 199 basis points. But here is a subtle and very important point. The probabilities we use in CD's pricing are not actual real-world probabilities. They are risk-neutral probabilities, which are derived from market prices. These probabilities are adjusted to reflect risk preferences, and they ensure that no arbitrage opportunities exist in the market. As time passes, the value of a CD's contract changes depending on market conditions. This is called mark-to-market valuation. If the CD spread increases after you have bought protection, your contract becomes more valuable, and you gain. Conversely, the protection seller loses. The mark-to-market value is calculated as the difference between the present value of expected payments and the present value of expected payoff. There are also variations of CDs contracts. One example is a binary CDs, where the protection buyer receives the full notional amount upon default, regardless of recovery. This effectively assumes a recovery rate of 0, which makes the CD spread higher. In fact, the binary CD spread can be calculated as the regular CD spread divided by 1 minus recovery rate. Another important development in this market is credit indices, such as CDX in North America and iTraxx in Europe. These indices allow investors to take exposure to a basket of companies instead of just one. Each company is equally weighted, and this helps in diversification. The spread on the index reflects the average credit risk of all the companies included. To improve liquidity and standardization, many CDs contracts now use fixed coupon rates instead of variable spreads. The difference between the market spread and the fixed coupon is adjusted through an upfront payment. The formula for this is upfront premium equals duration multiplied by spread minus coupon rate. If the market spread is higher than the coupon, the protection buyer pays upfront. If it is lower, the protection seller pays. Finally, there are CDs forwards and CDs options. A CDs forward is simply a CDs contract that starts at a future date. A CDs option gives the holder the right, but not the obligation, to enter into a CDs at a predetermined spread. If default occurs before the option expires, the option becomes worthless. So, if you step back and look at the full picture, a CDs is essentially a financial insurance contract where the premium you pay reflects the market's view of default risk. The higher the risk, the higher the spread. And at its core, the entire pricing mechanism is built on one simple balance. The present value of premiums must equal the present value of expected losses.